Welcome to the 2021 Economic Depression and Preparation channel. Thank you for joining me on this Wednesday, Hump Day edition, as we're in the middle of the week. And please be sure to hit that subscribe button for the latest from financial news. Thank you for your support. And today we're just going to talk about briefly the mortgage rates have fallen to a 2-month low, but weekly demand is still dropping, and that's indicative of an economy that's still recovering. It's an indicative of an economy that is still healing in terms of bleeding jobs. We will get the jobs report tomorrow at 8:30 a.m. Eastern Standard Time. Last week, as I reported to you, we lost over 545,000 jobs. Tomorrow, we're expecting about the same amount or just a little bit lower. Mortgage applications to purchase a home fell 5% last week. Even applications to refi a home fell 1% for the week, despite the lowest interest rates since the month of February. Lower mortgage rates are not prompting homeowners or potential home buyers to contact their lenders, as other obstacles stand in their way. So this decline came even though the average contract interest rate for 30-year fixed mortgages decreased from 3.17% from 3.20% for loans with a 20% down payment or less, and that is the lowest rate since the end of February. Refis were down 1% on 30-year fixed mortgages, 26 basis points higher a year ago, but rates were at record lows last fall. As you know, they were as low as 2.5, 2.6% back at the height of the pandemic crisis. So what we see here is that homeowners in certain areas, home buyers were putting up bidding wars and competition for the record low supply of homes of sales. This caused home prices to skyrocket everywhere around the nation faster in the 15 years than it has been. But even with today's lowest interest rates, it's not enough to make up for the ever-increasing cost of buying a home. And those costs, those maintenance costs, is what's going to eat up a lot of new first-time home buyers, a lot of millennials, and those in subsequent generations. Because not only do you have the mortgage, it's not just making the mortgage, it's making the insurance and the taxes, property taxes, and the upkeep. If a heat pump, a sump pump goes out, a water heater goes out, that's on you. A washing machine, a dryer, that's on you. Any repairs, roof goes down, that's $20,000 there by itself. So just any repairs that you have to be made, it has to be done, and that's what's holding a lot of eager buyers back. In addition to this bubble that we're in, because you're seeing that it's not just about the interest rates, it's about the jobs. When you're losing 500,000 jobs a week, a lot of this is not just fast food jobs and minimum wage jobs. Some of these jobs are white collar jobs. Some of these jobs are high paying jobs that have been shipped overseas. Either they're being shipped overseas, or technology and automation is replacing a lot of the jobs, and there's nothing to fill that gap. There's nothing to replace the jobs that are lost by technology and automation and by the offshoring of American jobs. And so since there's nothing to fill that void, of course the housing market is in the bubble. Of course this is going to be the time where the housing market is going to fall. Now the big question on every economist's mind and every channel's mind that you watch on YouTube is when that will happen. When will the housing market finally crash or correct? So in my estimation, in my prediction, I'm now looking at a housing market correction. Unfortunately, this is going to be a 50% or more correction, but this won't occur until next year, the beginning of next year. And the reason for that is because with the money that President Biden is pumping in for the infrastructure and all of these things, that is going to at least artificially keep up demand for these houses, and also with the low supply. But that's going to wane really quickly when people already have figured out that hyperinflation is here to stay. Inflation is not temporary, and people figure out that they're going to be upside down because these houses it's worth more than what's on paper, or worth less than what's on paper, I should say. So that's going to be the big caveat. Now, the bigger bubble that I am concerned about is the credit bubble, because once the credit market bubble and the commercial credit market bubble falls, that's when we have real problems. Remember, the reason why this whole crisis started, even before the health pandemic crisis, was because the Federal Reserve Bank had to bail out the bond market. You remember, they were putting $80 billion to $120 billion a month in the bond market, the bond and the repo market. Look it up. That's what started the whole crisis before the health crisis came. And so because of that, ladies and gentlemen, we are going to be seeing a major correction. Once the Federal Reserve Bank says, look, we can no longer do this bond and asset purchase program no more, we're cutting it out, then that's when trouble begins on Main Street and Wall Street. They will no longer be decoupled. They will no longer be disconnected. And so that's what we're looking at. Well, that will happen by next summer. Next summer, around this time, maybe around this time too, April, May next year, that's when the bond market, the Federal Reserve Bank is going to start pulling back some of these measures, and they're going to actually raise interest rates like they're supposed to if this economy is booming, but it's not that we know of. And so that's what's going to happen. Everybody thinks right now that everything's going to stay low and good, but what happens when they raise these rates? And they're going to have to, because even when inflation is going to be ticking up, everything by next year is going to be through the system. And that's what's going to happen. So continue to stack, continue to prepare, ladies and gentlemen, because this is just the beginning, and you're going to see it shake down through this summer and the fall as not only the virus increases in certain states, and we got to go back into 50% or maybe even 100% lockdown, and then the interest rates go up, and also the housing market, commercial housing market, and the bond market crash. That's going to be continuing into this depression. So continue to prepare, stay blessed. I'll be back with more news later. Thank you for listening.